The journey towards the promised land of single-digit interest rates is far from over. Even with the introduction of the Kenya Bank's reference rate in July last year, which was expected to serve as a uniform base lending rate for all commercial banks and therefore directly influence the end cost of credit to the borrower. 6 months down the road, the effect of that rate is yet to be felt, despite the notable decrease in the rate of inflation, thanks to falling food and energy prices during the last 5 months of 2014.
It has surprisingly taken a little bit long for that promised land to be reached. In terms of average lending rates by banks have only fallen by about 1%. So from about 16.9 to about 15.9. That is not a very big effect.
Although the central bank argues that the full effect of the kbrr will be felt once all loans are repriced in accordance with the new rates, what remains unclear is what banks load onto the kbrr to set their individual lending rates.
kbrr gives us a base, which is step one. But the second step is a bank has to charge a premium to a customer based on the credit worthiness of that customer. And that's where the ambiguity still remains.
Our efforts to get a comment from the Kenya Bankers Association on how the banking industry has implemented the kbrr so far did not bear fruit by the time we prepared this report. But analysts remain upbeat that interest rates will trend down in the next few months as the government cuts its borrowing from the domestic market and begins to spend on key infrastructure projects such as the multi-billion shilling standard gauge railway project.
The increased liquidity, which is emanating from the local expenditure from disbursements on the big mega projects.
I'm expecting us coming down by another 300 basis points or 3% to about 12. That should be manageable within the year.
Whether that prediction will hold true in the coming months now remains to be seen. Balagenga, the big question.